Now let's take a look at the cash flow going through the account of a trader speculating on S&P 500 futures. The performance bond is $12,563 and the maintenance margin is $10,050. The account looks like this. Day 1, contract is at 950 points, or actually the S&P 500 index is at 950 points. Our trader opens a long position. The margin required is $12,563, and the balance in the account is $12,563. On day 2, the S&P 500 index moves up to 965 points. At the end of the day, marking to the market, our trader receives in their account $3,750, bringing the balance up to $16,313. On day 3, the index drops to 961. Marking to the market again, our trader's account is debited $1,000, bringing the balance down to $15,313. On day 4, the index really drops down to 944. Marking to the market, our trader is debited $4,250, bringing the balance of the account down to $11,063. On day 5, the index moves up again to 950 points. Marking to the market, our trader is credited $1,500, bringing the balance up to $12,563. Day 6, the market plummets again, down to 930. As a result, marking to the market, our trader's account is debited $5,000, bringing the balance down to $7,563. This is below the maintenance margin of $10,050. There is a market call, which means our trader must bring the balance up to the original performance bond. Therefore, our trader deposits $5,000 in the account, bringing the balance to $12,563, the performance bond total. On day 7, the market moves up now to 940 points. As a result of marking to the market, our trader's account is credited $2,500, bringing the balance up to $1,563. And on the last day, the market moves up to 960, 10 points above our trader's initial position of 950 points. As a result of marking to the market, our trader's account is credited $5,000, bringing the total balance up to $20,063. Our trader then enters a reverse trade, closing the positions, and withdraws the funds of $20,063, leaving the balance at 0. So, in this example, our trader made a total investment of $17,563. That's the initial margin of $12,563 plus the variation margin of $5,000. The account was credited a total of $20,063. So we subtract the initial investment, and the profit realized is $2,500, or a 14% return. Due to the enormous amount of leverage associated with futures contracts, there exists the potential for big losses if the market goes against a trader's position. So, in order to allow for some control within the markets, the various exchanges institute daily price limits as approved by the Commodity Futures Trading Commission, or CFTC. And for an overview of daily limits, you can see an attached document in our course. Another important concept connected with futures, and specifically the S&P 500 index, is futures arbitrage. This process influences the entire financial market, and if an investor knows how this process affects the different markets, they can use it to help decide when and what to trade. Because future arbitrage has such a strong impact on the daily activity of common stock and options, we should take a close and careful look at it. In general, futures arbitrage is a simultaneous purchase and sale of futures contracts and their underlying asset, or spot. There are certain circumstances within the markets that give rise to any arbitrage. The prime factor is the difference in price on corresponding assets. Firstly, we should know what is the difference between the index futures and the index itself. It should be obvious that the index future is tied to the index because when we buy an index future, we gain the right to acquire a basket of stocks that constitute that index. If there were a possibility to buy index futures for half the price of the index itself, all that would occur is for investors to buy index futures cheaply and sell short expensive stocks that constitute that index. Thus we can draw a conclusion that futures can deviate from the index only slightly. When this deviation becomes greater than a certain value, an arbitrage situation occurs. Only then can the index futures and the index be simultaneously bought and sold in order to generate an instant guaranteed profit. Now, what is this certain value? Well, it's called fair value. Fair value is calculated as follows. In this formula, FV equals the fair value of a futures contract. SPX is the price of an index S&P 500, which is equal to the total value of the shares which are included in this index. R is the short-term risk-free interest rate from T-bills. T is the time or lifespan of the futures contract expressed in years. DIV is the sum of all dividends which are paid for all the shares included in the S&P 500 for the period of life of the futures contract. So, an example looks like this. The price of the S&P 500 index is 945.22 points. The time until expiration of the contract is 83 days, or in years, 0.2274. The yield of the T-bills is 5.44%, and the sum of all dividends is $7.41. So we apply this to our formula, and we get a fair value of 949.2648. Often the fair value is not shown as an absolute expression, as it is here, but as a premium or discount in relation to the index, and that is calculated as follows. In our example, the fair value of an S&P 500 futures contract has a premium of 4.04 points to the index. The fair value of the futures contract, in fact, reflects the expenses for holding the stocks that are in the index. These expenses are called cost of carry. In our example, the additional 4.04 premium accounts for the expenses carried up to the date of expiration of the futures contract. Now, let's assume that a futures contract with a close expiration date has a current value of 949.26 points, which is equal to fair value. Let's try to play an arbitration. Let's say we purchase a basket of shares with a current value of 945.22, and simultaneously we sell futures contracts at 949.26. We should guarantee to ourselves a profit at a rate or premium of 4.04 points. However, if we deduct cost of carry, our arbitrage gives us no profit at all. Futures contracts, as well as any other securities, change depending on the level of supply and demand. In any given moment, the demand can exceed its norm, and the price of the futures could become much higher than its fair value. On the other hand, when there are more sellers than buyers, there exists a low demand. Hence, the supply will drop below fair value. At such times, there arises an excellent opportunity for index arbitration. And such situations frequently arise, often several times within one day. Now, let's assume that as a result of increased demand, the price of a futures contract is 955 points. An arbitrator would notice that the price of futures is much higher than its fair value, which means there exists a real arbitration situation. So the arbitrator does the following. purchases a basket of the shares which are included in the S&P 500 index at 945.22 points, sells expensive futures at 955 points. Remember that a minus sign means a debit and a plus means a credit. Now, the arbitrator remembers that in order to calculate their real expenses, they must add to the basket of stocks its fair value. These 5.74 points constitute the arbitrator's profit. Naturally, they must also deduct commissions and other indirect costs. In reality, the profit from an arbitration, as we just described, will be lower. Massive sales of futures contracts cause their price to drop within seconds. At the same time, massive purchases of stock lead to the immediate rise in the S&P 500 index. As a result, the arbitration lasts for just a brief period. Therefore, an arbitrator never begins the process of arbitration unless the price difference between the futures contracts and their fair value exceeds a certain value, which guarantees a profit. This value depends on a number of subjective factors, such as how quickly an arbitrator can enter their trade. Having a computer with high communication speeds with the trade floor allows the arbitrator to begin the process with a smaller value, while still making a profit. Slow communications means the value needs to be greater in order for the arbitrator not to get caught waiting while the prices move past the profit-taking points. Now, the price of futures contracts should be above fair value by at least 0.7 to 0.9 points on average for a successful arbitration. This 0.7 to 0.9 point value is called a buy program. It is natural that the index arbitration can be conducted from both ends. Let's assume that the cost of futures was below fair value. That is to say, there was a discount. In this case, the arbitrator makes profits through a reverse process. They purchase cheap futures and actively sell the baskets of stock. The difference between the fair value and the futures price needed in order to begin a discount arbitration is called the sell program. Massive sell programs caused by discount futures arbitrations leads to dramatic drops across the stock markets. And, as would be expected, in the event of a massive buy program, the markets increase significantly. The arbitration situations, by virtue of the large volume of capital involved, are clearly visible on any daily chart. And here is an example using a chart for the Dow Jones Industrial Index. You can see that within the first 4 minutes after opening, the index has jumped up 70 points. This is the result of strong buy programs. You'll also notice that the momentum provided by these short-term arbitration carried through the rest of the day. The chart shows that the index arbitration occurred at the beginning of the trade session. It is not random. Trading is still conducted after the final bell at 5 o'clock in the evening on the CME, Chicago Mercantile Exchange. S&P 500 futures continue to trade till the next morning on a special network called Globex. During the overnight, there are many releases of information that can strongly affect futures. The following morning, at the CME opening, there can occur significant gaps between the futures traded overnight and the S&P 500 index, which in turn leads to arbitration.